Are we in a situation where good news is bad news? If this jobs report comes in higher than expected, do you think that's going to give the market some concern about these cuts?
Well, I think even if the report doesn't come in hotter than expected, if it comes in on consensus, I think that still perpetuates the notion of a solid labor market and gives the Fed plenty of cover to remain on the sideline as it waits to see further improvement in the inflation data. Remember, the market consensus right now is for about a 200,000 rise. Nominally, that's still very strong. While it is a loss of momentum, no doubt, from that earlier outsized increase at the start of the year, again, even at 200,000, that would leave the moving average closer to 300,000. So very much in line with Chair Powell's notion that we are seeing a tight labor market and they can take a very patient approach to rate reductions.
Okay, so we're seeing a tight labor market. We're also seeing rising wages. We're just showing the audience the forecast for this report is about a 4.4% increase in wages. Powell also made it clear they don't need to see inflation all the way down at 2%. They just need to see more reports where the trend continues. So rising wages, the right trend on inflation, do you believe that would not only give investors confidence, but the Fed confidence to make these cuts possibly in June?
It absolutely could, but unfortunately, I don't think that's what we're going to see. If you look at some of the latest inflation data, not only are we more bouncing along as opposed to seeing this clear disinflationary trend, but we actually saw an acceleration at the start of the year. Wages also ticking up in that early January report. Now, we are expected to see some reprieve on a monthly basis, but wages are expected to remain well above 4% on an annual basis, which perpetuates, again, this notion of sticky inflation and fails to give the Fed the confidence that they're looking for, that we are on a sustainable downward disinflationary trend back to 2%. Now, to your point, the Fed doesn't need to see inflation reach 2% before initiating rate reductions, but they do want to make sure that the momentum is very clearly established to the downside, and the latest data simply does not support that.
All right, Lindsey, as we mentioned earlier in the show, today is International Women's Day. One data point we're going to be looking in this report for is the employment of women, specifically women ages of 25 to 54. Right now, it's hit recently, as of the last report, hit a new high, bolstered in part by the shift to remote work and flexible hours. What does that say to you about this economy that we're seeing more and more women back in the workplace?
Well, I think, again, this perpetuates the notion that the labor market is seeing improved conditions. It's not only pulling workers from the sideline, but it is pulling women specifically from the sideline that were previously unable to participate because of elder care, child care, or other issues. And so we're continuing to see businesses increase the incentive for workers to move back into the labor market. And I think this is a net positive, particularly when we talk about reshaping that participation rate back to the pre-pandemic level, which could help continue to create a more sustainable level of growth in the underlying labor market to continue to perpetuate this recovery in the U.S. economy.